Hey there, Iguana Gang. Iggy here, and boy, do I have a hot topic for you today. We're diving into the Malaysian Ringgit Crisis. In this video, I'll break down what's happening, why it matters, and how it might affect you. Ever wondered why your vacation money suddenly buys less nasi lemak? Or why your Malaysian friends are eyeing jobs in Singapore? Stick around because I'm about to make sense of this financial roller coaster in a way that'll have you feeling like a currency expert in no time. Let's get this money party started. The Malaysian ringgit has been on a downward slide, recently hitting its lowest level against the US dollar since the Asian financial crisis back in 1998. This significant drop in value is being felt across the Malaysian economy, from the prices people pay for everyday goods to the health of businesses and job markets. It's a bit like if your weekly allowance suddenly couldn't buy as much as it did before. Your purchasing power has decreased. The ringgit's decline is due to a combination of external and domestic factors. On the global stage, the U.S. Federal Reserve has been persistently raising interest rates to combat high inflation. This makes the U.S. dollar more attractive to investors seeking higher returns, leading to increased demand for the greenback. Locally, Malaysia's central bank has kept its interest rates comparatively low to support economic growth and domestic spending. However, this has made the ringgit less appealing in the international currency market. Adding to the pressure, Malaysia's economy, which relies heavily on exports, has taken a hit from China's economic slowdown. Despite the government's reassurances and the central bank's readiness to intervene if needed, the ringgit remains in a precarious position as global economic headwinds continue to blow. When it comes to Malaysia's economic situation, you might be wondering why the country doesn't simply follow in the footsteps of other nations and raise its interest rates. After all, wouldn't that help stabilize the economy? Well, it's not quite that straightforward. Raising interest rates is a bit like a double-edged sword. On one hand, it could potentially help curb inflation and strengthen the currency. However, on the other hand, it comes with some significant drawbacks. If Malaysia were to raise its interest rates, it could make it more difficult for people to borrow money, whether it's for buying a home, starting a business, or financing their education. Higher interest rates mean higher borrowing costs, which could put a strain on individuals and families. Moreover, businesses might find it more challenging to secure loans for expansion or investment, which could slow down economic growth. It's a delicate balancing act, similar to choosing between eating your vegetables or indulging in dessert. Both have their benefits, but you can't always have the best of both worlds. Malaysia's central bank has to carefully weigh the pros and cons and find the right balance that supports economic stability without hindering growth and development. Let's talk about how this is affecting real people. Imagine you're a Malaysian worker like Ahmad Zulkarnain. Despite graduating from university a few years ago, the 31-year-old has been stuck earning RM3 for $500 a month at a small engineering firm. After paying rent, car payments, student loans, and daily expenses, he's left with just a few hundred ringgit each month. And now with prices of goods skyrocketing due to inflation, things have gotten even tougher. Or take Shanmugam, a cameraman. He used to give his daughter 2 ringgit for lunch, but now that only buys 2/3 of a meal. People across Malaysia are being squeezed by this combination of stagnant wages and rising living costs. Over 70% of working graduates earn below RM2,000 per month. A single person living in Klang Valley needs around RM2,000-2,600 just for a reasonable standard of living according to government estimates. But fresh graduates only earn an average of RM2,500, leaving no room for savings after essential expenses. It's forcing Malaysians to make difficult choices about how they spend their limited income. Some are even considering leaving the country in search of better pay, contributing to a brain drain. The government has taken some steps like raising the minimum wage to RM1,500, but for many, it still falls short of what's needed to keep up with the increasing cost of living. As prices continue to climb, Malaysian workers are walking a financial tightrope, struggling to maintain their quality of life on wages that simply aren't keeping pace. But it's not just individuals feeling the pinch. Businesses that import goods are struggling too. Think about it like this. If you're buying ingredients for a lemonade stand and the price of lemons suddenly goes up, you either have to charge more for your lemonade or make less profit. That's the situation many Malaysian businesses are in right now. Companies that rely on imported raw materials or finished products are facing tough decisions. They're seeing their costs rise as the ringgit weakens, making everything they buy from overseas more expensive. This affects a wide range of industries, from manufacturing to retail. For example, electronics manufacturers might be paying more for components, while clothing retailers are shelling out extra for imported fashion items. Some businesses are trying to absorb these costs to stay competitive, but that's eating into their profits. Others are reluctantly raising prices, which can lead to fewer sales as customers tighten their belts. It's a delicate balancing act, and many companies are finding it hard to stay afloat in these choppy economic waters. This ripple effect is being felt across the Malaysian economy, potentially slowing down growth and making it harder for businesses to expand or invest in new opportunities. There's also another interesting effect called brain drain, where more Malaysians are looking for jobs in Singapore due to the stronger currency. It's kind of like if all the smart kids in your class decided to transfer to a different school. It could be a big loss for Malaysia in the long run. To tackle this issue, experts have proposed some potential solutions. One idea is for the government to set up a comprehensive registry of Malaysian citizens working abroad so they can keep track of their skilled workforce overseas. They could then use this data to formulate strategies to encourage these talented individuals to either return home or contribute to Malaysia's economy in other ways, a concept known as brain circulation. Another approach is to better utilize the expertise of expatriates currently working in Malaysia. By having them train and mentor local employees, it could help upskill the domestic workforce. Offering more flexible work arrangements like compressed work weeks or remote work options may also entice Malaysians, especially women, to stay in the country's labor force. When it comes to the Malaysian ringgit's recent depreciation, it's not all bad news. In fact, a weaker currency can bring some unexpected benefits to the country's economy. For one, Malaysian products become more affordable for other countries to import, which can give a nice boost to the nation's exports. Think about it. If you're a business owner in another country looking to buy goods, you're more likely to choose the supplier that offers the best price. And with the ringgit's lower value, Malaysian companies can offer more competitive prices in the global market. Another silver lining is that Malaysia becomes a more attractive destination for tourists. Picture this. You're planning your next beach vacation and you're comparing prices for different locations. Suddenly, you realize that your money can go a lot further in Malaysia thanks to the favorable exchange rate. You can book a nicer hotel, indulge in more delicious local cuisine, and even extend your stay for a few extra days of relaxation. This increased tourism can inject some much-needed cash into the Malaysian economy, benefiting local businesses and communities. So, while a weaker ringgit might cause some concerns, it's important to remember that it's not all doom and gloom. The situation presents opportunities for growth in exports and tourism, which can help to balance out the challenges faced by the economy. It's all about looking at the bigger picture and finding the positive aspects in what might initially seem like a negative situation. So what's the Malaysian government doing about all this? They're trying a few things. They've asked government-linked companies to bring their foreign earnings back home, which has helped a bit. They're also focusing on attracting more foreign investment and moving towards higher-value industries. But here's the million-dollar question. Will the ringgit bounce back? The experts are divided. Some are optimistic, pointing to Malaysia's strong economic fundamentals. Others are more cautious, noting that global factors like U.S. interest rates play a big role. As investors, what can we learn from this? First, it's a reminder of how interconnected global economies are. What happens in the U.S. can affect countries halfway around the world. Second, it shows the importance of diversification. If you had all your investments in Malaysian ringgit, you'd be feeling pretty nervous right now. Finally, it's a lesson in the complexity of economic policy. There's no easy fix for currency issues. Every decision has trade-offs. And there you have it, Iguana Gang. We've cracked the code on the Malaysian Ringgit Crisis. Remember, Understanding these financial shifts isn't just for the pros. It's crucial for all of us. Whether you're planning a trip to Malaysia or thinking about investing in the region, this knowledge is your secret weapon. Now, if you found this video helpful, don't keep it to yourself. Smash that like button and subscribe to the Investing Iguana for more financial wisdom served up Iggy style. Got questions? Drop them in the comments below. Until next time, keep growing that financial wisdom, and I'll catch you on the flip side.